Good afternoon. Welcome to the third Engage for ESG webinar of 2025. We will start the event in a couple of minutes while we allow attendees to join the session. Please bear with us. Thank you. Good afternoon, everyone. Welcome to the third Engage for ESG webinar of this 2025 series, which is entitled Engage for ESG, a simple solution for ESG reporting. My name is Maitane Puente González, and I am glad to be presenting the latest updates of the Engage for ESG initiative today, together with Hikes Verschoor, a business analyst at Iboport, with a special focus on the Engage portal, which is going to be officially launched today. But in particular, we are delighted to have with us a very special guest speaker, Sergio Mayordomo, Head of Financial Analysis Division at Banco de España, who will present a research paper recently issued on climate risk, soft information, and credit supply. As a brief introduction, Sergio holds a PhD in finance from Universidad Carlos III de Madrid, and apart from leading the Financial Analysis Division at Banco de España, he is also a professor in banking and financial regulation at Universidad de Navarra. He's an expert in the area of sustainable finance. He is a member of the Engage expert group, and today he will be addressing this topic with this research paper. Welcome, Sergio.
Thanks a lot, Maitane. Thanks a lot for the kind introduction, and hello everybody. So first of all, it's a pleasure to present this research paper here that is somehow related to the topic of ESG. It's true that I'm going to talk about physical risk related to climate, but this paper is also about the importance of measuring properly the exposure of banks to physical and to climate risk, right? And to fully understand the effect of these risks on the economic activity through the bank lending channel. So the paper is a joint work with next please, with Laura Álvarez, who is a co-author at Banco de España, and two professors from ESE, Carles Vergara and Xavier Vives. So, as I said, it's about the importance of considering some soft information when there are climate events, and the importance of measuring the exposure of firms, that is, of borrowers, to specific risks, such as climate risk, in order to understand properly lending decisions. And this paper is about that, how the existence of wildfires affect bank lending through their access to soft information. Next, please. So it's about fires because, as you know, fires is a phenomenon that is affecting a lot Europe these days, and also the firms and banks. And it's very important to say that the intensity in terms of frequency and severity of fires fostered in many changes by climate change has increased substantially in the last 4 years. As I was saying, this is of course affected by climate change. And just to give you an idea, in the last 4 years, the wildfire season increased by around 30%, which is quite a lot, and it has a very important effect on the economic activity. And as you know, Spain is one of the countries that is more severely affected by these climate related events. And just to give you an idea, in 2022, very recently, Spain accounted for 40% of the total territory that was affected by fires in the European Union. But what is important and is related to the importance of measuring properly the exposure of firms to these events and to climate change in some sense is that it has very adverse effect on business activity. So we have some numbers in the paper, and we find that there is a significant drop in sales of the firms affected by fires over their total assets, and this ratio of sales over total assets decreased by 7 percentage points more as compared to firms that are very similar to those affected, and they are very close to them geographically, but they are unaffected firms. So this is just to tell you that fires are increasing in intensity and frequency over time, and it affects firms' activity. So it's important to consider there for banks. And it's not something that is part of the past. So in this figure, you can see the depending on the evolution of temperatures in the future, you can see how could let's say the exposure to high to extreme fire dangers could increase over time, depending on the number of days in which a country is exposed to this extreme fire danger. So as you can see, Spain is the country in which we focus for many reasons. First, because of the nice data that we have, but also if you focus on the last part of this figure, you can see that an increase of around 3 degrees in the temperature would increase the number of days with high to extreme fire danger in Spain by around 40 days, which is very significant. So we have to be, to take into account these climate event changes, and also the physical risk to which it could affect the real economy. And next. So what we do in this paper that I'm presenting now is, so we are going to answer the following research questions. So first of all, whether wildfires affect bank lending. This is whether wildfires affect bank behavior in order to lend the firms that are affected or not by them. And importantly, I'm going to focus on 2 different types of banks, because this is the other contribution of the paper. First is to try to see how physical risks, in many cases, as I was saying, driven by climate events, affect lending. And secondly, what is the difference between the local banks? Local banks are those that are geographically concentrated, versus non-local banks, that is the banks that are larger and the ones that lend, let's say, in the whole country, right? And the ones that I'm calling here outsider banks. And this is very important, right? Because you know that there are a lot of we are in the middle of a consolidation in not just in Spain but also in the euro area. We started in Spain many years ago, and it's important to understand the role of local banks to lend the firms that are affected by the fires, but also to be able to rely on soft information. So in many cases, large banks rely on hard data, hard information, and the advantage of the local banks, and one of the good properties for them is that they are able to have access to better soft information. So that's why the third research question that I'm going to try to answer in this paper is whether the behavior of local versus outsider banks differ depending on, let's say, whether for some specific firms, soft information matters more or less. You have in mind, for instance, SMEs, small corporations for which it's very difficult to extract information from the information that they deposit in the trade registries, and this is exactly what we want to do, to see the effects of these small banks, local banks, geographically concentrated, in order to lend to firms for which the information available is poorer. And finally, and this is a spoiler of what I'm going to show you later, but in case local banks are able to lend to firms affected by fires, Does it mean that they are taking more risks? And it has important implications in terms of financial stability. So it's not that local banks are able to lend to affected firms. In many cases, yeah, I mean, if they are very exposed to those firms, probably they are lending more. But the final question is, does it affect the risk exposure of these banks? That is affect the stability of these banks, and as a consequence, although they are small, of course, the financial stability of the system? These are the research questions. And next, please. And I'm going to give you now a very basic conceptual framework, because in the paper that I'm presenting, we have a very simple theoretical model, right? And the channels through which these wildfires can affect bank lending are three. So first is the potential allocation channel, in the sense that I was talking about outsider or non-local banks, the ones that are better diversified. And as you know, is probably they reduce lending to firms affected, but it's just because they can reallocate credit away from the disaster areas, right? So suppose large banks, that is some of the firms to which they lend are affected by fire. So probably you see a decrease in credit to these firms, because they are able to lend to firms that are far away from the fire. On the contrary, the local banks, the ones that are more geographically concentrated, probably cannot reallocate the channel out of the area because they don't have enough lending opportunities. And this is what explains the result. So in that case, our results wouldn't be driven by soft information. Our results would be driven by simply the different abilities of the two types of banks to reallocate credit. Second is the credit supply determinants, in the sense that outsider banks, the large banks, are better, they can absorb the financial shock associated to a fire, for instance, much better than local banks, in the sense that their capital is more robust, they have more liquidity, they are better diversified. So it's true that probably they can cut lending in that area, but this is not because they can reallocate the credit or not. This is just because they can absorb the risk, and probably they can continue lending there. And in that case, probably the outsider banks are able to lend more to these affected areas. But what I want to show in the paper is that the last channel, the one related to soft information, is the one that is more important in order to explain the role of local banks to properly understand the risk to which the firms are exposed, the degree to which their future activity is affected or non-affected, and then take proper decisions lending them. And it builds on the idea of soft information, in the sense that with soft information, banks can screen and monitor the risk of the firms much more properly. And what we find in this theoretical model, and what we build in the paper, is that local banks can better monitor the affected firms, mainly because when we run a very simple test and we see which is the physical distance between the firm affected by the fire and the bank, we find that the distance for the case of local banks with the firms is shorter. So it's important to be short of the firm in order to infer good soft information. And this is what we find in the paper. In many cases, because fires occur in rural areas, and the local banks are the ones that have more branches in these rural areas. So what we contribute in the literature, very briefly, is, we saw the role of these local, or let's say small banks, in maintaining credit supply after natural disasters. So measuring this risk is important, but also these banks are able to continue lending to firms affected by this disaster, and it builds on previous literature. The issue is that most of the previous literature has focuses on mortgages, or they have shown that the channel through which it happens is the fact that this internal capital market theory, in the sense that when a local bank or a small bank is part of a big group, the small bank can obtain funds from other, let's say, subsidiaries or the parent bank in the group, and then they can lend. We are focusing, as I was saying, in banks that are geographically focused. So this is different. We are going to focus on the use of soft information by local banks. And again, it goes to the beginning of the presentation about the importance of having good information in order to avoid probably bad lending decisions is very relevant to us to measure the export and to measure the characteristics of the firms in terms of these ESG rankings, for instance, and it's related to the topic that we are covering today. Let me very briefly summarize the data. So we use a proprietary data sets at the Banco de España. So we know the characteristics of all firms. So we see the financial statements through a Banco de España internal data set. Is mainly collecting the information that the firms report to the trade registries. And importantly, thanks to Savi, that is like the dataset that contains information on Spanish and Portuguese firms, we can see the specific geographical coordinates where the firm is located. So in some sense, we can see how far is the firm from the origin of the fire. The other unique data set is the corporate loan data available at the Banco de España, and we see all the bank firm relationships on a monthly basis. So we can see all the exposures, credit exposures of a given firm to all the banks that operate within Spain. And finally, for the case of wildfires, we use this CView data set that has information up to 2017. They are updating now the data. And what we do is to consider just the huge fires, right? The big fires. And this definition is not random. So when a fire is equal or larger, the affected area, right? 500 hectares, the fire is considered as a large fire. And in that case, the firm, of course, is strongly affected by the fire, and the fire could affect many firms. So we are removing all the fires that are small. We obtain the same result when we include them, but we want to focus on those fires that, according to the Spanish regulation, in some sense, are defined as large fires. And that's why we focus on these fires. So in the next map, you will see that the distribution of fires in Spain. So of course, they are concentrated in the north of Spain, the region of Galicia, but our results are robust to considering them or not considering them. But they are spread over the whole country. You can see that the largest one is one that took place in the region of Valencia. This is the biggest, with more than 20,000 hectares, if I'm not wrong. And in total, these points reflect the 337 wildfires that we have with a dimension equal or larger than 500 hectares. So we use all the fires from 2004 to 2017. We don't use information before 2004 because the coordinates of the fire were not well established in the data. So we want to see specifically what is the centroid of the fire in order to understand the firms that were affected. And now let me move to the empirical results. And here a caveat in the sense that we see for each fire what is the centroid of the fire. So we see in some sense where is the centroid of the fire, which would be this red area, but we cannot depict in some sense the specific shape of the fires, but we know the dimension of the fire. So we are going to consider, and this is very important for the rest of the paper, that a firm is affected by the fire, and this is referring to the dark red area here, when the firm is within a circle whose size is equal to the one of the fire. But again, given that we don't know the shape, we assume that it's a circle, right? So the magnitude, the size of this red area that you can see in the center of this figure, the size is equal to the size of the fire. And it depicts a circle with the radius equal to r. So what happens? Of course, the shape is not perfect. It's not a circle. It could have different shapes. And what we do is to consider that the firm is affected by the fire if it is within the circle, which is equal to with a radius equal to r, which is again the radius corresponding to the real size of the fire plus 10 kilometers. And we consider this plus 10 kilometers because, as I was saying, the shape of the fire sometimes is not perfect, but on top of that could be firms that are not directly affected by the fire, but they are very close. So in some sense, part of the business activity of the firm could be affected by the fire. So the red areas define the affected area, and all the firms within this area, based on their coordinates, are considered to be affected by the fire. Then you can see a white area here, this ring. These rings are firms that are excluded from our sample because they are firms that are close to the fire, but we cannot see whether they are affected or non-affected. So we remove them to focus and to compare the firms that are in the red area versus the one that are in the green area. That is firms that are far away from the affected area in this ring that goes from the radius plus 20 kilometers up to the radius plus 40 kilometers. They are close, they are in the same municipality, very close to the others, they are very similar characteristics, but they are far away from the centroid of the fire. And we are going to compare how banks learn to the firms in the red area versus the firms in the green area. So in the table below, you can see the characteristics of the affected versus the non-affected firms. So in total, in our sample, we have more than 50,000 firms that are affected by fire, that is, that are in the red area, versus around 400,000 firms that are in the non-affected area, in the green area. So what you can tell me now is that, fine, but probably the firms are very different. The firms that are in the affected area are very different from those in the non-affected area. And what we want to show in this table is that is not the case. So if you see, for instance, the size of the firms computed as the logarithm of total assets, the return on assets, or let's say the capital over total assets of the firm, you can see that the firms in the affected and non-affected areas are very similar in terms of these basic characteristics. And we are going to consider them when you conduct analysis. So of course, there could be other differences, but in terms of the main characteristics, they are similar, and the difference is whether they are affected or unaffected by fire. So the empirical strategy, and I don't want to spend much time here, but it's just to show how we estimate the effect associated to the fire and the lending activity by local banks. So this is a very simple econometric specification in which our dependent variable is just the change of credit granted by a given bank B to a given firm F between the year after the fire and the year before the fire. So that is, so we are going to see the change in credit granted by a given bank to a given firm in the period that spans 1 year before and 1 year after the fire. And as you know, I mean, we use a lot of, we have to compare firms that are similar. So what we are going to do with these fixed effects here is to consider firm time fixed effects, which means that we are going to compare the credit supply of two banks. One is local, the other is not local, to the same firm. So in this way, we can identify how two different banks, one local versus one non-local, treat the same firm. And we are going to obtain the average effect. Of course, we consider that banks could operate in different provinces, and we also compare, use the fixed effects at the bank's province time level. And our variables of interest in our regression analysis are these two. So the proportion of credit that a given bank B has in a given province P over 1 year before the fire. So it tells you how concentrated is the credit portfolio of a given bank in a given province before the fire. So when the concentration is very high, suppose that a given bank just operates in one province, this would be 100%, right? If the bank operates in 5 different provinces with the same amount of credit in each province, it would be 20% for each province. And then we interact this variable with a dummy variable that tells you whether the firm is affected by the fire. That is, whether the firm is in the red area that I was showing before. So in this way, we isolate with this identification strategy the credit supply that goes to the firms affected by the fire, depending on how concentrated is the lending activity of the bank. And this is the only equation that I'm going to show, and then I move to the results. So the results can be classified in three groups. So first, we need to understand what happens with local banks after the fire. And secondly, we want to see what happens with local banks when soft information matters. And I will give you some examples, some cases in which soft information matters more. And finally, I'm going to show you what happens in terms of the loan performance of the bank when they lend more to firms affected by the fire, and what are the real effects in the province where the firm is located in terms of the employment in those areas. So how a good monitor of firm characteristics by banks could help extending credit to affected areas and to sustain, in some sense, the local economic activity. And this is very important, again, and is related to the importance of properly reporting of the information by banks. So starting with the first one, next please. The first hypothesis, so what happens at the firm level? So I was explaining that we are going to consider the differences between local and non-local banks, but what happens with the firm that is affected by the fire? So this is the first thing that we want to answer in the paper. And the specification that we use to answer this question is not the same that I was saying before. Here is very simple. So we collapse all the credit that a given firm has, and we compare the evolution of credit within a given firm before and after the fire. And what the first column is telling you when we consider this radius plus 10 kilometers to define the affected area is that a firm that is affected by a fire, that is in the area that we consider as affected area, decreases the amount of credit by around 6%. So this is a sizable and significant effect, not only in statistical terms, but also in economic terms. So firms that are affected by a fire see a drop in credit. I will explain you later where this drop in credit comes. Then we can say, fine, I mean, this 10 kilometers radius is random. So we are going to consider two different radius, up to 5 kilometers and from 5 to 10 kilometers. And you can see that in both cases, of course, I mean, the farther we are from the center of the fire, the lower is the effect, but this is still very significant. That is, our results are not driven by the magnitude of the fire. So if I consider 5 kilometers, I would find the same or even stronger effects. So the next question that you might have in mind is, yeah, but this is probably something that is occurring before. So if local banks, for instance, are the ones that are moving this, they have better information. So probably they are cutting lending to the firms even before the fire. And what you can see in the third column that I'm reporting here, column number 3, is that when we consider what is happening with the evolution of credit of a given firm before the fire, you see that there are no significant differences. So firms that are affected by the fire 1 year after, the year before the fire, they obtain the same credit as firms that were not affected. So it's something, let's say, a shock, no, that is affecting to the firm and cannot be predicted by banks before. The other question that we always get is, yeah, but this is probably, the results that you get is probably because firms that are affected by the fire probably exhibit a different demand. So suppose that, I mean, they don't want to continue with the activity, the decrease in credit could be driven by the fact that the firms don't want to obtain more credit. So it's driven by demand and not by the supply of banks. And what I show you in this fourth column here is that when I consider the applications of firms to banks, that is when they demand credit, you see that there are no differences. So there are no differences in the demand of credit of firms affected and non-affected by the fire. So the drop in credit should be driven by supply. So banks are cutting credit to firms affected by the fire, and it's not driven by firms demanding less credit. So the next, please. And here we go directly to the second hypothesis. That is, okay, but what happens with local and non-local banks? What explains these results? Do they behave similarly or not? And here I go back to the regression specification that I have seen in the beginning. And here you can see the interaction of the proportion of credit that the bank has in a given province interacted with the dummy that is equal to 1 in case there is a fire. So the larger the proportion of credit, the more local, let's say, is the bank. So you can see that local banks extend more credit to firms affected by the fire as compared to non-local banks. And it doesn't matter, I'm not going to spend much time here in columns 2 and 3, but it doesn't matter whether you consider whether the bank is more or less specialized in the province or in a given industry, in the sense that probably the firms in a given industry are very special. It doesn't matter. And importantly, in column 4, we add the bank market share. So this is very different, right? So in our measure of interest, we are seeing the distribution of all the credit of a given bank in different provinces. And here with this new variable that I'm adding in the column 4 is the market share of the bank in that province as compared to the total credit in the province. And as you can see that our results are not driven by the market share of the bank in the province, not at all. Our results are driven by the specialization or the concentration of credit of the bank in the province that is affected by the fire. And this is where local banks extend more credit. And in the next slide, I will try to give you an idea on what explains this. So at the beginning, I told you that there were 2 potential channels or mechanisms that can explain our results. So the first one is that, well, probably we observe these results because local banks don't have lending opportunities. So if a given firm in a given province is affected by the fire, the fact that you see that local banks are lending more is not driven by having better or worse information about the firm. It's just driven because local banks, they don't have lending opportunities, so they cannot do anything. So they have to continue lending to them or they don't lend. And in order to answer this question, what we're going to do is to split the firms, the area, sorry, depending on the lending opportunities that there are in specific provinces. So there are low lending opportunities or high lending opportunities can be defined based on the sales in a given province, or in terms of the gross value added in the given province. We have other variables defining this. So just to give you an idea, let me focus on column first and on the first and the second columns. So there are low lending opportunities in a given province when the vast majority of the sales in that province are affected by the fire. So the vast majority of the sales are done by firms that are affected by the fire. So if there are low lending opportunities, it means that, look, all the firms have been affected. Most of the firms in the area has been affected. Their sales have been affected. So, I mean, they are lending to them because they don't have lending opportunities. And this is what we find. So we find that when there are no lending opportunities, local banks lend more to firms affected by the fire. But interestingly, if we check what happens in column 2, there we observe that even in areas where there are more lending opportunities, that is when not all the sales or not all the firms have been affected, but there are still firms that are not affected by the fire. So you can continue lending to firms not affected, and you can continue with your lending activity. But you can see that even in those areas in which there are high lending opportunities, local banks also continue lending more to firms that are affected by the fire. Of course, the magnitude of the coefficients are very different in the sense that the lower the lending opportunities, the more the local banks lend. That's true. But even when there are a lot of lending opportunities, local banks also lend more to firms that are affected by credit supply. So it's not about the ability of one bank or the others in order to reallocate credit out of the affected area. This is not the channel. And in the next slide, I'm going to show you, in the next slide, I'm going to show you what happens with soft information. So regarding soft information, we are going to focus on first of all, the first channel to obtain soft information, that is relationship lending. So the closer or the longer or the stronger the relationship between a given bank and a firm, the higher is the quality of the information that the bank can obtain for that firm. So relationship lending should matter. And what we do in this table here, so the first column refers to the baseline results that I have just described, is to split the firms in column 2 and 3, the pairs of the firms and the banks, in two groups, depending on whether their lending relationships are considered as low or depending on whether their lending relationships are considered as high. And this low or high is just driven by the median of the bank firm lending relationship. So what you can see here is that, of course, lending relationship matters. Lending relationship is a channel through which banks can obtain good information or good, let's say, quality information from the firms. And the stronger the relationship, the larger is the amount of credit that local banks are extending to firms affected by the fire. When there are no lending relationships, this effect is not significant. So this is the first way to show you that soft information matters, and the first way to show you that soft information matters is through relationship lending. But if that is the case, sorry, last column in the previous slide, sorry. If that is the case, then the paper is about relationship lending. It's not about soft information. So yeah, relationship lending is good to obtain soft information, but it's not about the quality of the reporting. It's not about anything else. And what you can see in the fourth column of this table is that, the previous table is that even if we focus on firms that didn't have any type of relationship with the banks, the probability that a given local bank is lending to a firm affected by a fire increases and establishes new relationships. So it goes over and above the role of relationship lending. What this column is telling you is that local banks also establish new relationships. So it's not about relationship lending. It's not about evergreening in the sense that I have a high exposure to you. I prefer lending to you to avoid that you cannot honor the debt. So what is commonly known as evergreening. No, it's not the case. I mean, they are also lending to new clients. And in the next slide, I go to the next point related to soft information. What happens with firms that don't have any type of bank debt? So if this is relationship lending, the results should not exist here. And you know, in Spain, and it's not just the case of Spain, in other countries such as Portugal, Italy, 50% of the firms don't have bank debt. So it's true that bank debt is very important for financing, but half of the firms don't have bank debt. In many cases, because they don't demand for bank debt. So what we do in this table is, okay, so let's focus on this specific group of firms, firms without previous bank debt, firms that don't operate with banks. This is not relationship lending, right? And what you observe here is that local banks are also lending more to firms affected by the fire when they didn't have any type of bank debt before. So firms that obtain a credit by the first time. But what is very important, when we split the firms into groups, depending on whether they are distressed, the second column, or non-distressed, the third column, they only lend to firms without previous bank debt when they are non-distressed. So they are not taking risks lending to distressed firms. And this goes again in favor of the idea of soft information, because they are able to monitor and to screen these firms properly, lending to those that are non-distressed. And in the last table of this section, what I have is, next please, is a result that is very related to this to the importance of firms reporting information properly and to having good reporting standards, right? So what you can see here is that we split down the firms into groups, depending on whether the firms are more or less opaque. And this is based on this standard accounting literature, which is based on accruals. So the larger the accruals, the more opaque are the firms. The lower the accruals, the more transparent, the less opaque are the firms. So importantly, what we find here is that local banks lend more to firms affected by the fire when they are more opaque. So when the firms are transparent, local banks treat the firms in the same way as non-local banks, as the large banks. So there are no differences in the lending to these firms, to the ones that are more transparent. But when firms are more opaque, local banks have competitive advantage because they can screen and monitor the firms better. So larger banks rely on hard data, hard information. They stop lending to them. And local banks lending more to them because they have more information, soft information on these firms. And importantly, we find the same result. They do this when the firms are non-distressed, not when they are distressed. So next, please. And to conclude the presentation, what I have shown you up to now is that, fine, local banks are lending more to firms affected by fire. So if this is the result, and we just consider what is happening in terms of the ex-ante risk, in the sense that they are not lending to distressed firms, that's fine, but what happens later? So what happens 2 years after the fire? And what I want to show you in this table is the evolution of the NPLs of a given bank in a given municipality, depending on whether the municipality is affected by the fire. So we measure in some sense the NPLs for each bank in the municipalities in which there was a fire 2 years after the fire. And what you can see is that no differences in terms of the local or non-local banks. That is, local banks don't face more NPLs in the future in spite of lending to these firms that are affected by the fire, which again goes in favor of this idea that after a climate shock, local banks can screen and monitor firms better thanks to their better access and to their better soft information, because they are closer, as I was saying, in terms of distance. And finally, in the last column is about the importance of measuring properly, right? The next one, please. That one, perfect, thank you. So about the importance of measuring the effect of these climate events on fires, right? And about the importance of measuring it properly and to continue lending to firms that even when they are affected, they can repay the credit. And what we find in this slide is that employment in fire-affected areas decreases when there are not local banks. So areas that are affected by the fire, they see a decrease in employment around 1.3%. It's not so much, but this is something important, right? In columns 2 and 3, we consider areas in which there are strong local banks that have more than 90% of the credit concentrated in that province, or there are no local banks, in the sense that we don't have any bank with more than 90% of the credit concentrated in the affected areas, in the affected areas where the firm is located. And what you can see here is that when local banks are present in the areas affected by the fire, employment doesn't change. On the contrary, when there are no local banks, employment decreases significantly. And just to conclude, I mean, the paper is related in some sense with the topic of what the European Data Warehouse is trying to do, because it's important to measure properly the risk. It's important to measure properly the exposure of climate risk, the exposure of whatever we want to measure, because it matters for lending. It matters for lending, and it matters also for the economic activity in the areas to have a good measurement of the real risk. So local banks have more advantages to have access to this soft information. And as you can see, they are able to lend better and to lend to better clients. They don't face NPLs, and they contribute to sustain the local activity. And just to conclude, this is the final slide. So it's about the mechanism, as I was saying, of soft information versus hard information, what matters. We have shown, and also we have a model showing that local banks have better access to soft information. And importantly, we find that local banks play an important role in mitigating the effects of climate shocks in the economy. And I think that this is very relevant, having in mind that the banking systems in many countries are suffering a consolidation. So, I mean, local banks are very important to deal with these shocks. And that's all I wanted to say. And of course, the views here are my own and do not necessarily coincide with those of the Banco de España. I have to say the disclaimer that I didn't say at the beginning. Thanks a lot.
Thank you very much, Sergio, for guiding us through the research paper and the results. And indeed, it sets the perfect scenario now to present the Engage initiative. So before going deeper into the Engage portal presentation, for those who are not especially familiar with the Engage for ESG initiative, by the Union. Part of I think you lost I think I lost the connection for some time. Can you hear me now? Okay, thank you. Thanks for confirming. So I was saying that the Engage for ESG initiative is a project co-funded by the European Union, which was launched in November 2022 by a consortium of 6 European entities: European Data Warehouse as the coordinator, IPOPort as the IT partner, 2 lending institutions, Unión de Créditos Inmobiliarios and Bonu, part of Nationale Nederlanden, as the pilot institutions testing the Engage templates and the Engage portal. We also have a research partner, Università Ca' Foscari from Venice, and a consultancy firm supporting us in privacy and GDPR matters, Dexai. Which is the scope of the initiative? Well, the objective is to create a simple solution for ESG reporting for mortgages and home renovation loans. First and foremost, to check the alignment with the EU taxonomy regulation and always in compliance with the Energy Performance of Buildings Directive and the General Data Protection Regulation. How are we doing this and how we are achieving this objective? Through 2 main pillars. And these are first, a disclosure template for residential real estate data, the Engage templates, and an IT infrastructure, a portal to assess the EU taxonomy alignment. The Engage templates have been developed around 3 blocks. Building block 0 is actually the current ESMA underlying exposure templates under the securitization regulation for residential mortgages and consumer loans. Building block 1 is effectively the Engage add-on section. So those are the data fields required to check the alignment of the loans with the Climate Delegated Act section 717772. And the last building block, which is currently under construction, is the one addressing the information requirements to capture funds from the green financing programs of the European Investment Bank, according to the green eligibility checker criteria. We won't extend much today on the Engage templates because we have covered them in detail in previous events. And in any case, the templates are available upon request through the link that we have inserted also in the presentation in the last slides. So please feel free to ask them. And last, before I give the floor to Hikes, I would like to share with you that the Engage for ESG initiative is consolidating its position in the market, and that we aim to become an industry standard this year in 2025. As an example of this consolidation, the initiative was mentioned as a best practice in the Hellenic Financial Stability Fund report, sustainability report from 2023, where the fund encouraged all Greek banks to join the initiative to support the increase of sustainable finance and to promote better monitoring and measurement for banks' lending portfolios. So with this background, we will move now to the presentation of the Engage portal. Hikes, over to you. I facilitate now the slides.
Yes.
Here we are.
It's not loading for me, I think. But let's just start with the fact that as of today, we're live with the Engage portal. And I do not yet see the slides, so Maitana just suggests to go immediately to the portal, which is, of course, better. There's the slides. Then a quick overview. Engage portal will enable lending institutions to upload and assess the alignment of their loan portfolios with the EU taxonomy. The basis output is the data quality feedback and the AUT taxonomy alignment report, which I will show later. Next slide, please. It's not fully loading for me, Maitan. So with an eye on the time, I suggest that I take over the screen to show the portal. So I will do that now. So you should be able to see my screen right now with the Engage portal. We made a demo financial institution for this webinar, namely Hypoport Bank, since Hypoport is the company I'm working for. We made an example portfolio, a pilot portfolio, RMBS deal based in the Netherlands that is current, which we can then use to upload the data under. Then, add file. It's one button you can press. A description, I will call it demo, needs to be filled in. Pool ID, this is something I come up with, and this is always to be determined with the data owner. Then the cutoff of the data I try to upload. And the current template that we are using is the version 1.1. So that one is the one I'd like to use. Then the zip file containing the 4 Engage files can be uploaded, where the naming convention is always the same with the pool ID underscore and then the cutoff in order to facilitate smooth processing. And then the file is uploaded, and afterwards checked. You can see the upload is successful. Well, this is now busy. We see that it's updating and analyzing the file and generating the output. And there are 3 different forms of output that the user might get related to the 3 different statuses. So at first, the upload might fail because certain format checks or data quality checks are hit, which ensure that the file cannot be checked completely. Then you will still get a report, but then not with the EUT alignment file and with the data checks, but a .txt file explaining the errors with the upload. In that case, if you're starting to use the portal, then please contact us via the support email in order to find out together with us if the instructions are unclear, what is going on. So now the download is complete. I can download the report, which then contains the both of the reports that I already opened. And you can see that the status is file review ended successfully, but with some warnings. So the data is not as clean as we would like for and we check for, but there are still some data inconsistencies. However, the file was good enough to make the output for. So then first, what might be some checks that might be hit? For example, if construction year is earlier than the date of construction permit application date. Some logical checks that we do in order to check if the file has been made correctly, to see if the logic within the file and the different columns within the file that relate to each other make sense. Other example might be that the prime energy demand of building equal to NBD5 when nearly zero energy building NZEP threshold is populated. A bit technical, but these are all examples of checks that we have incorporated and we provide feedback for. Then the second file is the EU taxonomy assessment overview that is based on the assets that you upload with a number of loans, number of building units, a balance, and most importantly, the TSC pass percentage. And then below it, the overview per section and economic activity, and then the overview per part with the percentages, the building units, the amounts, and the total loans that are part of each category. Then I wanted to also let you know that so Hyperport Bank is now a data owner, but you can also facilitate, or we can also facilitate different rights per institution, since I have now upload rights and I also have view rights. So it means that I'm allowed to upload data and that I'm allowed to see the reports for this Engage portfolio. But it also might be the case that you prefer, because you have different departments within your bank or different investors that should watch different portfolios. You should be able to access different portfolios, that you might want to add more rights to them. So in the meantime, I changed my rights, and now I'm also able to see a Belgian portfolio, a Dutch portfolio, and a German portfolio of all our neighboring countries, on which of each of them you can again add files, but also as a data owner provide access to investors to only view the output, or to colleagues to be able to upload only for the Dutch mortgages or maybe only for the German mortgages. That is then completely to be designed together with us. Then lastly, what I want to show is how do you get in? How do you register? If you go to the URL engage4esg.eu, you will find the button with the login request, in which there's a form that you can fill in order to apply for the portal. Of course, there's some other items that then have to be checked, of which Maitan will tell you all about it in order to how to get a test user for the portal. Back to you, Maitan. You're on mute still, Maitan.
Thanks, Hikes, for letting me know. So how can you get to use how can you become a user of the portal? First of all, if you want to request the templates, these are available upon request through the link that you can see on the slide. More than 70 institutions have already requested access to the templates. And once you have seen this and you want to become a test user, we will ask you to sign a standard legal arrangement that we have prepared to ensure the safe transfer and the safe processing of the data. And once you have signed this agreement, you will be able to log in and to start using the portal and to start submitting information. We have prepared a guidance document for the Engage templates version 1.1, as well as a sample file regarding the specific instructions to complete the Engage templates, and a user manual to guide you through the Engage portal to make this process easier. So if you want to start using the Engage portal in the next days, we will facilitate you this information after receiving from you an email showing interest on that. And as Heike said, for each sample submission, 2 reports are generated, a data quality report and an EU taxonomy alignment report. In this slide, we have mapped the benefits of becoming a trial user. And I would like to highlight the fact that the Engage templates are transaction agnostic, so they can be used for mortgage portfolios as well as RMBS transactions and covered bonds. They are to be reported in the user-friendly format, actually CSV. And you will be supported by the Engage team of iPort and European Data Warehouse when submitting your files. Last but not least, we would like to invite you to the upcoming Engage events, both in person and online. We are hosting our next in-person event in Madrid on 7th May at Instituto de Crédito Oficial. So if you are based in the city or nearby, we would love to welcome you there. And regarding the webinars, the next session is taking place on the 29th April in the afternoon at 3 o'clock. You have here the registration link. And we conclude here today's webinar. Thanks a lot for joining us. We hope you found this information interesting. Thanks, Sergio, and thanks, Heike, for your participation. And to the audience, we look forward to welcoming you in one of our next events. Thank you very much, and good afternoon.
Thank you, everybody. Thank you, Maitane. Good afternoon.
Thank you both.